J to the TGI fucking F, man. How you doing, man? How's
My
the week?
brother from another mother, and basically my damn brother. I'm good, man. I'm good, man. You know, I had to grab another energy drink because low key, I feel like I've been going all day today, and I still got a lot of shit to do. Let's get into it.
All right.
Well, before I do want to go over some data, of course, as always, if it's important data that comes out that day, so you can kind of give the intro, and then I'll give that data, and then we can jump right into it.
All right. Yeah. So today we're going to be analyzing the book, The Great Devaluation, and we're not just going to be analyze it. We're going to be going over the most important parts in the book, because as you guys know, I take notes on all the books I read on the most important part. But we're going to be talking about how it relates to current times and how you can use this information to become a better investor, because we are a group that is designed to help you invest like the institution so that you can grow your wealth long term for generations. So you wanted to go over some data?
Yeah, I'm not here for the bullshit. Say no, but anyway. So today was a very important inflation day. So PCE and core PCE came out today. So just to illustrate the difference between CPI and PCE real quick, consumer price index and price consumer expenditure. So essentially the biggest difference is what they track. And so you got the CPI, it tracks like urban households specifically, and then it tracks, you know, all the food, but it doesn't track any Medicaid, Medicare, insurance, employer-based insurance. PCE factors in Medicaid, Medicare, basically things that aren't directly payable, and they also factor all households versus just urban households. So anyway, that's like the biggest difference between the two. And so PCE came in today. This is headline. PCE came in at 3.5. That's up from 3.3 last month. And also core came in at 3.9 as expected, and that's actually down from last month. And so you got a mixed bag here, right? You can kind of paint multiple pictures in that, you know, inflation is still stronger, or we're not seeing enough disinflation still. It's still that's a solid number. 3.9. It's the first time we've been under 4% since 2021 on that core PCE, but it's 3.9%. And so, you know, you can make a case for it, or you can make a case, oh, inflation is decelerating. The Fed is achieving their goals still. They're on track, and a soft landing is totally possible, which I wouldn't agree with if you said that. But yeah, that's for another podcast. I just at least wanted to lay out that data, and it's up to the audience to infer what they want from that into the next episode.
Well, I mean, I guess I'll lay out too. Say no. All right.
I didn't get that one.
You said I'll lay out the data.
I think you're losing it. Say no. No.
All right, here we go. This might be self-explanatory, but for anyone who's listening for the first time, I'm just gonna read it. And again, I read this book back in like 2019, I believe. So, you know, I was really just
I think we basically bought it like the week it came. That wasn't 2019. It was 2021. It came out right after the pandemic.
Oh, and, no, you're right. Because I was
and we bought it like pretty much as soon as it came out. Yeah, we caught that thing.
Yeah, it was it's a great book. I definitely recommend. If I had to give it a rating, that's another thing we should start doing. I'll give it a 8.5 out of 10.
You know, I'm gonna give it 2 ratings. So at the time that it was released and when I read it, I actually gave it a 10 out of 10 for the content it had, but also the way it broke it down and how current it actually was. And it's a book, so that was like a rare thing for me, because that stuff was still happening as I was reading the book.
And still is today.
Yeah, and still is today. But also, let's look at how it aged. You know, I would say probably a 7 out of 10.
I actually give it a 9. It's a lot of timeless stuff in there.
Yeah, but also, you know, when they make predictions in books like that, and it's all pointing towards a prediction. I mean, the book itself is called The Great Devaluation, so it's all pointing towards a prediction. And whenever you throw that in there, it just gets a little messy, man. I'm gonna be honest. It's like the data is so good, and then it points to you saying something drastic, like, yes, so the U.S. I'm not saying he said this in the book, but the U.S. dollar will be no more in 5 years. You know, some people do that.
Well, it's not.
And
no, I'm just playing.
But yeah, so 7 out of 10 as far as how it aged, but 10 out of 10 when I read it during that time.
All right, cool. Let's get through all this. All
Yeah,
right.
I couldn't read any of these notes, by the way.
I wrote these notes with my feet, so I'm sure it's kind of hard to say no. Yeah, for those of you who don't know, my writing is pretty sloppy. So here we go. I can't read it either. Say no. All right, enough jokes, man. The Fed buys bonds and then deposits cash into the banking system. Banks are then able to lend the money. This increases the money supply and the credit supply added to the system. When the Fed sells bonds, the opposite occurs. The supply shrinks and interest rates rise. Why do I feel like this is the first point I write down in every finance book review that we do?
I don't know. Kind of. It feels like it, huh? It does seem like that. Like this is always the point at which we start for some reason. But yeah, I mean, look, the Fed still to this day, they're the leader. They're the largest bondholder, and they own still to this day, $5.5 trillion of U.S. Treasuries, and they're gonna have to get those off their books, right? So they're rolling off the balance sheet now. But yeah, that's how we ended up here.
Yeah,
and over the last, and this has been happening over the last decade, as they became, more of that backstop for the banking system to offload their bonds for more liquidity, especially the bonds that they were no longer making money on, the banks. And so they offloaded that to the Fed because the Fed can operate at a loss pretty much forever. And they provide liquidity to these banks to extend loans and whatnot. And that's literally how we survived without getting a huge downturn throughout the whole, pretty much 2010s. Everybody thought every 2 years the recession was coming during that time. In 2011, 2013, 2014,
Yeah, I mean, I don't really have much to elaborate on that. It's supply and demand. So that's pretty much self-explanatory. I feel like you said it all. Next point here. The corporate subprime debt market is 5 times the size of the subprime mortgage market prior to the housing collapse. Now, this is pretty significant because, so just to give you a quick explainer on the subprime mortgage, the subprime mortgage is basically the subprime mortgages were that wasn't the package.
No, so
right?
yeah, so subprime mortgage, you can look at it like just someone who's not a quality borrower, but still they extended the loan to you. So effectively they were 600 or below, I think that number was at that time.
Yeah, if you guys watched the movie The Big Short, there was a scene where Steve Carell, I forgot his name in the movie, but he was knocking on someone's door to question them on their loan or something. And he was like, I forget the person's name he asked for. He's like, "Where's Bill?" And he was like, "That's my dog," or "That's my neighbor's dog," or something. So basically, the barriers to entry or the criteria that they were using to hand out mortgages were so low that you were able to get one in your dog's name. So a lot of people were getting all these mortgages because they were like, "Oh, my house is going to go up. I'm going to make money." A lot of them were variable rate mortgages. So when interest rates rose, their interest payment rose for their mortgage, which led to a lot of foreclosures, which collapsed the economy because you had all these mortgage-backed securities packaged together, and the rating agencies were not being honest. Let's just put it that way. So it's like, so you get that. So now the debt market is in corporate debt. So it's basically the regulations to borrow money for a corporation versus a person taking out a mortgage is extremely low. And you guys saw what happened during 2020. People were getting all those PP loans, PPE, PPB, all these Ps. It's so many loans that people were getting. I know people that didn't even have a business. They were setting businesses up just to get the loans, right? So once all that money gets into the system, and it's not being put into some kind of productive effort, things have to it's like a house of cards at that point, because it's just fluff. So I'm not sure how things are going to play out, but I feel like this is going to be a big trigger to our recession as interest rates continue to rise. All of these companies who took on all this debt, their cost to service that debt is going to continue to rise, cause a big deleveraging, which is just the act of selling your assets to pay off debt. Because if you don't have a business that is making money, you're gonna have to either lay off employees, sell some real estate you have, sell some equipment that you have, whatever to pay off the debt. And as you're doing that, as you're laying off people, one person's income, and one person's spending is another person's income. People stop spending, businesses stop making money, and the whole thing just kind of comes down.
Yeah, and just to add to that one thing, You kind of touched on it, but yeah, that's literally the environment in which you create zombie companies. So if you're talking about a subprime corporate borrower, so that's someone who isn't rated investment grade. That's someone who, kind of like you said, they can't afford to pay off their debts ever. So they can't afford to pay the principal on their debt. They can only afford to service the interest payments every month, and that's it.
For a certain time.
Well, some of them, shit. I know there's some from like 50 years ago. I bet that there's a zombie company that's been around for 50 years, because a lot of these companies just survive on debt, especially when debt is cheap. And so he was talking about, what was the other point he made? So go ahead, read it again.
The corporate subprime debt market is 5 times the size of the subprime mortgage market prior to the housing collapse.
Oh yeah, so that was the point. So yeah, so basically, man, yeah, 100%. When you have, and now it's way more exacerbated just because interest rate policy, which is part of the reason the Fed in certain environments has to come in and buy some of those bonds as well from those banks, just because they're not profitable loans. And yeah, it's getting bad. And I wish I had a chart. I'm going to try to find a chart for the next video of the level of zombie companies, because I've always been curious, but I never actually looked at the actual percentage at any point in time that it exists, all where zombie companies exist at a high number. I'm sorry, my talking is kind of fucked up right there, but yeah, you get what I'm saying.
Corporate buybacks have amounted to more than 50% of the stock market returns over the past decade.
Corporate stock buybacks, right? Yeah.
Yeah. Through the last 2 years, Warren Buffett has been widely criticized for not buying back more Berkshire Hathaway shares. Berkshire Hathaway is the holding company he owns that owns all his companies. The stock has suffered as a result. Buffett now sits on over 125 billion, which will allow him to sustain the next economic downturn. Okay. Corporate buybacks. Let's talk about this. So from 2000, I think it was 2010 to 2020 was the longest time that the stock market was in a bull market, like a consistent cyclical bull market, right? Obviously it had its breaks down, but if you look at the long-term chart from like the 2010s to like 2020, basically to the
that would be considered like a secular, because it's more long-term.
That's what I meant. I didn't mean to say cyclical, secular. Thanks for correcting me on that. As long as bull market we had, and a big reason why is because 1, interest rates were low, and 2, companies are buying back their own stock. And this isn't always a bad thing, because when you're a public company, when you have a board, an important thing to do is to increase what's called earnings per share. And sometimes a way to do that is to buy back your own stock. And buying back your own stock can help because you can borrow against it. And like you can use it for good things. So I can borrow against my stock, take that money, use it to expand the business, hire more people, et cetera, et cetera. But a lot of these companies weren't doing that. They were just buying back their own stock and pretty much trading it so that they can make more money. So
stock buybacks as well, just to insert this, and this is the only thing I have to add to it. Stock buybacks are popular because large companies usually have a lot of cash on hand. And when you have a lot of cash on hand, it's a way to put that money to work while providing more value to the shareholders. So that's why it became popular, just because like someone like Apple, that's why they get criticized, or they got criticized for not initiating more buybacks at one point in time, just because how much cash they just had laying around. So you can kind of look at it like, in a way, printing money.
Yeah. And for you guys, if you don't know right now, like at the time of this recording, Apple's in the midst of the largest stock buyback in history. And if you look at their chart, and as you can see, every other stock had like a pretty big breakdown, but they never got like really lower than 136. This has been like a strong support and resistance zone. And as you can see right now, like they're still near all-time high levels. So the important thing about this is that while we were on the longest secular bull market, it wasn't just because the economy was prospering and everything was good. It's because interest rates were low and companies were buying back their own stock, which was pushing the price up. And when companies buy back their own stock, it makes people buy back their own stock, and then it's just a big cycle. So as an investor and you're navigating this landscape, sometimes it's good to just go with the tides. Like if like when a stock is undervalued, it's not a uncommon thing to think, well, shoot, the company's probably looking at their stock, realizing that it's undervalued, Everything else seems risky right now. We're about to go into a recession. People aren't spending as much money. A lot of times their best investment is their stock. And it could be a good investment for you because if a company's buying back their stock, like had you bought Apple at 136, you could have made some money when we're supposed to be in like, you know, a quote unquote recession. So yeah, that's all I have to say on that. Oh, you said your point already too, right?
Yeah.
Okay. The next one. Not only is the Fed buying the underlying bonds directly, they're also buying the ETFs that own the junk bonds. JNK, the ETF that tracks subprime corporate credit, is up 20% since the announcement. So this part is probably outdated. I'm not sure where it is right now, but it's basically talking about how
I can't really speak on that one though.
Yeah, it's basically talking about how they'll buy an ETF that tracks subprime corporations. So we just talked about a subprime corporation is a corporate borrower that isn't institutional grade, which means it's a lower likelihood that they're going to pay off their loans. And the ETF is basically, it stands for exchange traded fund. So it allows you to buy stocks like regardless of like what time it is. It's basically like a stock that is 24 hours.
Did he say the Fed was buying the ETF as well? Did he say that?
Yeah, he said not only is the Fed buying the underlying bonds directly, they're buying the ETFs that own the junk bonds.
See, I don't even remember seeing that in the book. I never heard of that. I don't know anything about that. I didn't know. I mean, I'm sure they use some type of SPV.
Yeah, and just so you guys know, a junk bond is
SIV in this case, structured investment vehicle.
Yeah. So, and just to like demystify a little bit here, a junk bond is a bond. So when a company or a municipality, city, or whatever issues a bond, they're basically taking on a loan. Like it's two main ways to raise capital. You give up equity to get money, or you take on debt, which is saying, hey, let's say we want to raise $1 million. We'll issue 10 bonds, just for example's sake, $100,000 a piece, 2-year bonds at a 5% interest rate. So you give them a loan of $100K, aka buy their bond, and you get paid $105K over 2 years. So a junk bond is a bond that is less likely to pay back for whatever reason. That's why they call it junk.
Well, okay, to insert right there. So basically, it's a company who's not investment grade. So they're not rated as an investment grade company. And so because you're taking higher risk, it comes with a higher yield. So that's why, by the way. But yeah, you can finish.
Yeah. So basically the Fed was buying these junk bonds just to kind of prop up the economy, which is crazy because people will look at it like, well, if these shitty companies that issued these bonds aren't doing too bad, you know, maybe things aren't too bad because obviously the shitty performers are going to go down first. So the Fed are buying them to try to create the illusion that things are going well. And that's why JT was saying that he's sure some companies that's been a zombie for like 50 years. And the reason why they're a zombie is because they're getting liquidity from somewhere, aka the Fed, to, you know, help them stay afloat. Anything to add on that?
Nah.
Okay. Each time the Federal Reserve has lowered rates to offset recessions over the past 40 years, it has begun that effort from a lower number. 18% in 1981, 9% in 1991, 6% in 2000. I think this says the plus minus. I don't know what this says. Whatever this says was 5% in 2008, which is why the Fed needed to print nearly $4 trillion as well. So basically, the issue, what they're saying here is that the Federal Reserves like to have rates a little high so that when something happens, they have like some room to lower rates before they get to zero. And the big issue with the pandemic was that interest rates were already pretty low and the economy was really, really fucked. And that's why we saw 0% interest rates, because they had to lower them from a lower place and hit a floor versus going from high to somewhat low. And the lower the disparity or the lower the wiggle room you have to lower rates, the more money you have to print, which is why they printed so much money.
So just to add, so the Fed has two primary ways that they would try to inject liquidity into the market, which is lowering interest rates and printing money effectively in the different ways that they print money, or in the different ways that money is printed, I should say, semantics. But yeah, so those are the two ways in which they, basically carry out QE or quantitative easing. So yes, like you said, you want to be at, so right now, for example, so the real rate on the Fed funds rate is like 1.5%. And so that's, some people would say restrictive because we haven't been at a 1% real rate in forever. So some people would say that's restrictive, but some people would say restrictive has been at 2%. And Jerome Powell would say, we don't know if we're restrictive. So we're going to wait till more data comes out, which he just said a few days ago. But anyway, so those are the two ways that they would battle or that they would carry out QE. And I'm sorry, I kind of blanked on the point. What was the point again?
Basically, they lower interest rates from higher floors.
Oh, yes. So, yeah, so we want to remain. That's why I think interest rates or the Fed funds rate, especially by how the bond market is performing, it might get up to 6.5%. Probably not. But if it does, I would not be surprised at all. But that's going to be a good thing because we want to have a higher Fed funds rate. So that way, when, not if, when something does happen again, and then they have to carry out a form of QE, they want to start with interest rate policy. Eventually, I don't think they will go below 2% for the next like 50 years. That's probably overdoing it. It probably 10 to 20 years. I don't think they would go below 2%.
I'd say 15 to 20.
Maybe. But I don't think they would go below 2% anymore, 2.5% on the Fed funds rate. So that way you always have that room to carry out interest rate policy. But on the flip side, if you're at the lower bound on the Fed funds rate, so if you're at where we were at the beginning of the pandemic, let's say, I think at the beginning of the pandemic, we were at, 1.25 or 1.5%, and we took it down to 0.25. That took like fucking 1 or 2 meetings. I can't remember exactly. So it's very quick that he took interest rates back basically down to 0, which left the only option is to print money. And the way the reason they had to print money is why we have such interest inflation today, which is on the fiscal side, because most of the money that was printed during the pandemic went to consumers. And what do consumers do? They consume. And so they went spending crazy. And that's why everybody started screaming, oh, this is going to be so inflationary, blah, 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 blah. And they're like, oh, we're good, bro. Calm down. We got this. Out of nowhere, 9% inflation. They're like, damn, we didn't foresee the effects of fiscal policy. Of course you didn't, But anyway, so that's why you want to have a higher Fed funds rate. So that way you just have room, obviously, to carry out interest rate policy, because you don't want to print money if you don't have to, because in a way, money is always being printed, especially on the fiscal side. So from the monetary side, you want to avoid that as much as possible, because that actually does
the difference between monetary and fiscal policy a little bit.
Yeah, so you can, to keep it very simple, fiscal is government, monetary, Fed. Simple as that. So when I say fiscal policy, that has everything to do with the stimulus, like even the stimulus now, like with this, or all the spending now, with the IRA, Inflation Reduction Act, the infrastructure bill, all that shit, the ERCs, that's all fiscal. Anything that comes to like bank lending. So like if the Fed provides liquidity to banks for them to extend loans, that is going to cause more asset inflation, because that's a monetary policy tool, because they're working with the bank, the Federal Reserve is. And so asset prices, you'll see, get the first hit of that inflation, which could leak into consumer prices, but it doesn't necessarily have to work that way. But on the flip side, if you see more fiscal stimulus or fiscal injections in terms of liquidity, that's going to hit, your more consumer goods inflation and services. So that's the difference.
Okay. No, that's good stuff. And like, just to tie this in to how you can use this information to become a better investor, and feel free to chime in whenever. You have to think about the economy is like, most of these indicators and things that happen are lagging. Like, you can think of the economy as a big ship, right? When you're in a jet ski and when you turn the wheel, it's going to turn immediately. But you see in the movies, when you're driving a ship and they have the wooden wheel and they spin it, it's like the ship starts moving very, very, very slowly before it starts to pivot. And the economy works in the same way. So when you're investing and you're looking at interest rates, like right now, we're in a time where rates are really high. So debt is high and they're sucking money out of the system because interest rates on everything is increasing. Car payments, house payments, like any type of financing is more expensive right now, and people are spending more on that versus investing. So they're taking a risk off approach. So when you have high interest rates, you can get a guaranteed yield through buying like a treasury bond or any kind of bond, because the bond interest rates are high too. However, when interest rates are low, people tend to take more risk. And remember, this is lagging. It isn't automatic, because when the Fed eventually does pivot and they start to drop rates, you would think like, oh, the party's back on, money's cheap, people are going to invest into asset class. Remember, this thing is lagging. Every time in history when the Fed pivots and drops rates, that's when we see the bottom, actually, before things start to turn back up. So right now, or after the bottom is in, the Fed lowers rates, that's a good time to really take a risk on approach, because now interest rates are low, so you can't get that guaranteed yield in the bond market, and liquidity needs to find a home somewhere to appreciate, because you have all these fiduciaries managing all this money to get a return for their investors. Then you can take more of a risk on approach. Did you have anything to add to that? Okay. Insider projections from the Fed have suggested that for every percentage point below 5%, the Fed would need to print $3 to $5 trillion. This means when faced with the next recession, the Fed will need to lower interest rates from 1.5 to 0%, then need to print 10 to 18 trillion to offset the recession. So JT kind of just touched on this point, and he was saying why it's good to have rates this high, because when rates are at 4, 5, 6%, you can raise them 2, 3, 4% and not be a zero and not have to print as much money. And the whole goal, like I was just saying a few minutes ago, is to suck money out of the system, so that it's like when you're investing in cryptocurrency, you want to be holding the cryptocurrency that either has a cap supply or has a burn rate, aka they're burning transactions, like Ethereum. EIP 1559 burns Ethereum on each transaction. So the Federal Reserve, through raising and lowering interest rates, controls the scarcity of the currency in the US dollar. So by them turning on interest rates and people servicing all their debts in the form of bills, it's sucking money out of the system. And when you're sucking money out of the system, aka dollars, supply and demand says when you have less of a currency, it increases the purchasing power. So that's the whole point. And that ties into them trying to control inflation. Anything to add to that?
Yeah, I was just going to add, I never heard that. Is like, I haven't read this book in years, guys. And I probably didn't, I'm sure I wasn't as aware as I am now, even though it's only a few years, you just always.
A lot happens a few years, especially when you learn it every day.
So I'm not familiar with that statistic, with that correlation with interest rates below 5% and the amount of money you need to print to kind of make up for that or to offset a recession. I'm not familiar with that, but I mean, it did kind of play out that way. So we were below 5%, and we did print $10 trillion effectively. So
all right. So now this next one is talking about the yield curve. So yield means the rate of return you can expect when lending money. That's like what we're talking about on the bond. The yield is the coupon rate, the interest rate that you get paid for buying the bond. The yield curve addresses the rates of return we expect when lending to the government. When the yield curve flattens, it means that longer term bonds are not offering high interest rates than shorter term loans.
Basically, you can look at, so let me start from the basics. So you got a price and you have a yield on, let's use the 30-year bond example here. So the yield on that 30-year bond is 4.7. The price, I actually don't know the price right now, but anyway, so they have an inversely correlated relationship. So when the price go down, yields go up, and when yields go up, if yields go up, price go down. So if price goes up, yields go down. So they're always doing the opposite, right?
And why is that?
Just because, so the less valuable they are, that's like more risk. So the higher perceived value. And some people on like the 30-year, they call it the term premium, which is not a thing you can really measure, but perceive, if that makes sense. And so the term premium or premia is basically like the excess return that you would get on for locking your money up in a 30-year fixed or in a 30-year bond. So bond yields on 30 years are usually higher. So in a normal yield curve, so here you're sharing your screen actually. So if you guys can see, in a normal yield curve, that would be opposite. So it would kind of be like that, the gray line at the bottom there, that would be an example of like a somewhat normal yield curve, right? The higher you go out on the curve, the higher the yield, because the higher the perceived risk, because your money's locked up for a longer period of time. So your yield should be higher. What we have now is an inversion. So if you look at that blue line, short-term yields are higher than longer-term yields. And so if you look at the 2-year, for example, and a lot of people use the 2 and the 10-year to compare. So yeah, so if you look at the 2-year yield, you know, we're looking at a 5% yield on the 2-year and a 3% yield. I'm sorry, a 4.7% yield on the 30-year. But it gets more interesting the shorter term you go. So if you want to go back out, so look at the 1 month. That's why cash is so attractive right now, because you're looking at a 1 month T-bill that's paying you 5.3%. Now, why in their right mind, why would anyone go long out on the longer end of the curve? Well, to be honest, I don't know. I can't speak to that. So it just wouldn't make sense, right? Like it just like, if you can get 5% on a 1 month, why would you lock your money up for 30 years for 4%? I mean, you're talking about pennies, you know? So that's not really an attractive thing right now. But anyway, so that 5% is a reflection of what you would get paid on by holding that bond for 1 month. So, you know, you put in $100, you're going to make $5, you know, for
That's
that
pretty
month.
good. That's actually excellent.
No, that's fantastic for 1 month. And if you were able to do that every month, right? And it's been steepening even more. So we got yields rising in the short term, but you also got them rising on the longer end of the curve there as well. And so to go back to his point, I want to make sure I tie back into his point. Can you read it one more time?
Yeah. When the yield curve flattens, it means longer term loans are not offering higher interest rates than shorter term loans.
Oh, yeah. So he just stated like an action. So yeah, when it flattens out, he said long-term loans are not providing higher interest rates than short-term loans. So yeah, flattening is like before it inverts. And so I got to just throw some numbers out here for this example. So at one point, you know, the 30-year yield was higher than, let's just use the 2-year again. So it was higher than the 2-year. So it was the opposite. It was more like that gray line we pointed to at first. At one point, they hit the same level, or basically the same level, which is a flattening. And so it would depict itself on that chart. That blue line will be more flat than it is now. And so because you can now get 5% on a 2-year, even though you can also get 5% on a 30-year, well, you're probably investors are probably going to pile in on that 2-year, just because the term premium to own a 30-year bond is just not there. And so it doesn't make sense. And so I should add this in as well. The Federal Reserve, so they directly control the short end of the curve. They don't have as much control. They don't have really any control on the longer end of the curve. But by manipulating interest rates, they directly affect, you know, up to the 10-year effectively. And so that's why, you know, some people use the bond market as like an indicator where the Fed funds rate is going to be. So yeah, so they directly affect it with monetary policy. I should say that. And so that's why when you saw interest rates rise over this interest rate cycle by the Federal Reserve, you've seen steady bond increases, and they're still rising. And which is another reason why I wouldn't be surprised why we're going to see a 6.5% on the Fed funds rate.
Good stuff, man. Couldn't have said it better.
Probably.
Okay.
No, I'm just playing.
Yeah,
I want to go ride my new bike, bro. Jesus. Anyway, go ahead.
Anyway, so to tie it into, you know, how you can use this to make a better investor, this kind of goes into the point that I was just saying. So it's like you would be less likely to invest in, not you, but institutions who have strict risk management, who controls 98% of the money in the world. Why would they go and buy a stock when they can get 5.4% in 1 month, when the stock can drop 10, 20, 30% on any given day at this point?
Well, to even reframe that further, bro, if you are investing millions of dollars, like if you are investing millions of dollars,
You can
Why
live
would
off of
you?
this yield.
Why would you buy anything else other than a risk-free 5%? Why? It
And when he
literally
says
wouldn't make
risk
sense.
free, it is risk, but it's the lowest risk you can imagine because you're basically banking on the federal government, who's in bed with the Federal Reserve, to pay you your yield back. It's not like a corporate bond where the company can go down anytime. Like, this is the government.
So I mean, yeah, why would you buy anything? Which is another reason why I think the short end of the curve is probably going to go higher than it is now. I've even heard estimates on the 30-year at 5.25. I can't give you any estimates, but I can at least tell you that on the long end of the curve, but I can at least tell you, if yields are going to keep rising, we're probably going to see a higher Fed funds rate, guys, on the short, if yields rise on the short end of the curve. And it looks like they're going to.
Yeah, man. Interesting times. All right, let's go to this next point. We have been in this exact position before when facing a debt crisis. In the 1950s, when our dollar was strong relative to the world, the solution for Franklin D. Roosevelt was to weaken the dollar against gold. By executive order, gold ownership became illegal. Once it had all been recalled, with a stroke of a pen, FDR raised the price from $20 to $36 per ounce. When faced with a debt crisis, the only move out is a currency devaluation.
$36, man. 35? Why is it 36? That's just so weird.
I don't know.
I don't think that's the truth. It was $35 an ounce.
Okay. When faced with a debt crisis,
it's just $1, but yeah, fuck. Go ahead, bro.
When faced with a debt crisis, the only move out is a currency devaluation. Until that devaluation occurs on a structural level and a new system is adopted, the world faces tremendous risk.
All right, so that plays into his like his overall prediction, bro. That's what I was saying in the beginning. Like, if you look at, it's funny, he kind of sounded like Ray Dalio as well. You good? Oh,
my bad. I had some. I didn't know I was on camera. I'm on another website. My bad. Go ahead. Let me not do that. I'm glad you said something because I would have kept doing it. Some in my eye.
Yeah, man. But yeah, he sounds like Ray Dalio, but that's going to play into his prediction. The only solution to a debt crisis is currency devaluation. I would agree, right? If we weren't the U.S., I don't know. It's just we always come up with something new to like stop our existential collapse. And that was part of his thing, that the US dollar is going to be no more pretty much at some point in time. And then he started arguing for an asset-backed currency with gold. And that just doesn't make sense to me, and a lot of other people. But anyway, yeah, the only way out of a debt crisis is a currency devaluation if you're like China or someone else. It's like the US. It's like, will our debt number ever turn into a crisis? Some people say it's a crisis right now. And I'm pretty sure that's what he's saying, that we were in a debt crisis then. But it's like, wow, we've been in a debt crisis for a long time, if that's the case. And we just crossed 36 trillion. The deficit is going to be 33 trillion. The deficit is going to be 6% of GDP. The cost of service, that deficit is going to be 2.5% of GDP. And we're still probably going to grow, just low growth, but grow. And our currency is always being devalued. I'm surprised it's not worth zero. It's just weird. It's like, it's weird that you can lose 90% of your purchasing power, but then it's not worth zero. Like, what? That doesn't make sense, because it's this fucking fiat system. Because when Peter Schiff gets on the internet or gets on these podcasts and he talks about, you already lost 90% of your purchasing power, and then it's going to keep going. He's been saying that for 50 years. He's right. But also, it's like, how is this dollar even? It's crazy that it still says one. It's crazy that it's still fungible. It's crazy that I don't feel like I lost 90% of my purchasing power. It's crazy that it doesn't feel like the US dollar is about to go away tomorrow if we lost 90% and we only got 10% to go because of the system we have, bro. It's so weird. How do we have hyperinflation? Like, how? Somebody explain that to me. So it's just, I don't know. When people go existential like that, and I just look at what's happening and what has happened, it's like, bro, now you make yourself seem wonky to me. And I respect his work, obviously. But it's just like, when you say something like that, I just kind of let that go in one ear and out the other. I'm going to be honest. And I focus on all the other good things that person has said, like a Peter Schiff. Just because, like I said, I mean, if you lost 90% of your purchasing power, like, how is it not worth zero? How is it not gone already? And so our debt crisis, is it a debt crisis? Are we capable of having a debt crisis in the US? A real debt crisis, like Germany, a real debt crisis.
Not as long as we got world reserve currency, I don't think.
It's different, man. It's just different. Like that dude J Main said, that do the Say Cheese interviews. It just hit different when it's fiat.
It hit different and it's built different. So
no, but it is though. Like I just don't see the existential huge threat like he's painting right there, and he's gonna probably do it again. I hope he wrote it because I know that prediction. And that's why I gave it that 7 out of 10. But
fair enough. So just to so you guys understand, there's a quote: "He who owns the gold makes the rules." And this is a perfect example of that. So it was Executive Order 6102. So he who owns the gold makes the rules. And the reason why they could change all the price is because when you have all of the gold, or 90% of it, however, whatever percentage they had, you can say how much you want to sell it for. But if the gold is in other people's hands, they'll accept it for what they want to accept it for. So when he had all of it, and now that people were able to buy gold again, it devalued the currency because now the gold's price was different, not just to the Federal Reserve, but to everyday people as well, because people start back buying gold. This is the reason why I really like Bitcoin. A lot of people are saying oh, Bitcoin is competing with the dollar. Bitcoin is an asset. It's not a currency. So it's not competing with the dollar. In order to be considered a currency, you have to be deemed non-taxable upon transfer. And Bitcoin is taxed. It's property by the IRS, by the SEC, by the CFTC, all of the governing, regulating bodies, whatever you want to call it. But the cool thing is in this regard, it offers stronger property rights than a gold, because gold is tangible, which is in many ways, or at least in this way, its biggest downfall. Because if someone issues an executive order in the United States, you know how hard it is to get your gold overseas? You ain't gonna want to ship that shit because you might lose it. It could get lost. It can get stolen. It's heavy. Bitcoin is weightless, and it's on a network. And if someone issues an executive order, you can open up a Swiss bank account or some account somewhere else. Or if you have a friend overseas, hey, I'm about to send you this Bitcoin, and you don't have to worry about if it's going to get there safe or not. So it will be much harder for any institution or company or regulatory body to issue an executive order on Bitcoin, because they know that it will just flee overseas. So that's
okay. Michael Saylor over here. Yeah, man. So I agree, actually, with Bitcoin. So I agree with both points. So for one, hey, anyone who ever tries to tell me that Bitcoin is going to be a currency, let's argue about it. Okay. Let's debate any day. Come on, seriously. Give it to me. Say no, but
whoa.
Yeah, man. Look, hey, one thing that I actually it kind of irks me when I see, because bro, this debate has been happening for so many years. Is Bitcoin as money? I hate seeing that title for anything. I hate it because it's not, and it won't be. Now, I agree. When it comes to property rights, of course, you have provenance, so that's huge. Obviously, the transferability of it. Obviously, you can take it anywhere. So I think if you can mine the volatility as an individual, it'll also be a good store value, even in the downturns. Every year, at any given point in time, it'll probably still be up 50 to 70% year to date, right? I'm talking about year to date metrics on that. And that's every year. It's like every time I look at it, every single year, it's like, oh, year to date, it's still up 40 to 70%, So if you can mine the volatility, it makes a good store value. And it also makes a good property transfer. And when I say property, I'm just talking about capital, to be honest. Yes, you can transfer other goods through the blockchain if they're digital, but when it comes to capital, yeah, there's no borders. You could send it anywhere. Yeah, you got to wait to 7 confirmations, but at least you don't have to wait 2 days or whatnot. And so, yes, I agree with all of that.
Good stuff. All right, next point. The United States stayed out of World War I during the first 2.5 years, openly debating if it was our war to fight. They remained neutral in the conflict, and it turned out to be great for the United States, bottom line. The American economy would boom while we sold materials, ammunitions, commodities, and other goods to both sides fighting the war. As supplies headed out, gold flowed in. And since British and France were losing, the United States knew that they had to step in to get their money back. The Lusitania, if you guys watched our last book review on the creature from Jekyll Island, yeah, definitely give that video a watch if you guys haven't seen that. Learn the history of the Fed. It's mind-blowing. Anyway, the Lusitania, which was a transatlantic passenger trade ship equal to the size of the Titanic, was 600 tons of pyroloxene, aka gun cotton. I know I pronounced that wrong. 6 million rounds of ammo and 1,248 cases of shrapnel shells. Was hit by a German torpedo on Friday, May 7th, 1915, killing 1,198 civilians, 128 of which were Americans. This served as an emotional trigger for Americans to get involved in the war in order to protect the loans made to the Allies. That's crazy.
That is crazy, man. Yeah, that's just crazy, bro.
And that's
yeah, that's crazy.
Yeah, when you hear about like people making money from war, like the United States is like, oh, these motherfuckers at war, we're just gonna step out, we'll supply the war. And through supplying the war, they got paid to supply the war. But to the side that they supplied more goods to, they were starting to lose. So the United States was like, shit, these motherfuckers might not give us our money back. Let us step in and win this war for them just so that we can get our money back. So they set up the whole Lusitania because they can't just make people go to war because we're not a communist or socialistic economy or society. So they had to create a problem first in the Lusitania, have some Americans killed so the Americans could be like, these motherfuckers. Basically. And then give people a reason to want to get into the war. Also, they can get their money back. That's crazy, man.
Yeah. Yeah, man. Yeah, that is insane, actually. It's crazy that people can be, and when I say people, I mean a group of people can be like, all right, guys. That's why I always follow the money. In anything, I just go to the source. The source is always money. Always. I don't care what it is, origins,
bro. No matter what.
Yeah, it's always money. So it's always important to follow the money, and it's not hard to understand. Maybe it's hard to understand, but it's not hard to see them doing that. Because I mean, yeah, if you go upside down on $1 billion, I don't know what their loan amounts were in totality. Probably just in the hundreds of millions at that time. But if you go bust hundreds of millions of dollars upside down on loans in the 40s, I mean, Jesus, man, that's going to be bad. And when did they enter was the gold standard implemented in 1944? Was it implemented? 1944.
Bretton Woods, right?
Yeah. Was it 1944?
I can't call it.
I think it was 1944. Some very soon in this time frame, though. But if you have, currency backed by gold and you go bust on a few $100 million, I mean, who knows what would happen?
Yeah,
at that time. So
my bad. Go ahead, finish.
No, that was pretty much it.
Yeah, I was gonna say, like, since you bring up Bretton Woods, like that is a big reason why we hopped off the gold standard in '71 because this happened. We got all this gold from financing this war.
I think there was like run on the Fed basically from foreigners, and so everybody started basically coming at one time. So they're like, "Oh, I gotta halt them." Well, you know what? We're just gonna depeg it.
Yeah, and then that
happened in '71.
United States been the world reserve currency,
bro, and that shows you like these people who advocate for an asset-backed currency. There's not one that exists today on a mass scale. Not one that exists today on a mass scale. And this in the U.S. lasted for 25 years, 26 years, bro. That's not even like this in a time in the whole scheme of things. Like that's nothing. It doesn't work. And they caught wind of that early. They're like, yeah, we can't keep doing this, y'all. We're gonna have to depeg this shit. Yeah. And so they went ahead and ended it. Simple as that. And that's when gold started its uptrend, effectively, by the way, from 35 an ounce to like what it is, 2,000 an ounce. And gold is probably one of the best barometers of currency devaluation, by the way, because our current it's almost like a direct correlation where, of course it moves up and down at any given time, but you can look at your purchasing power by looking at the gold price over the last 50 years, which still is like, okay.
Which is why they wanted to devalue the currency against gold.
Right, exactly. So it kind of balances out. But it's like, man, this is such a weird system, bro. You know, maybe I
That is a
understand
reset.
it.
That they resetted it. They literally reset the price of gold. Like that's what the reset is.
Yeah, that's true. You know what's crazy, man? I wonder when I'm like 80, if or 70, will I have a full understanding of this shit? It doesn't seem like it. There's always something. There's so many moving parts. There's always something to learn. It just don't seem like even 70, 80-year-old dudes, they just don't have it all because it's just so much. It's just so much information, bro. I love it. It's kind of crazy.
Yeah.
Anyway, yeah,
It's a
go
lot.
ahead.
All right, so let's go to the next point. We're almost done here. So tariffs are a nationalistic approach that encourage domestic consumption over foreign goods. So you have, I wrote down here, wealth gap. An increase in wealth gap leads to populism. Populism leads to nationalism. Nationalism leads to tariffs. Did you want to speak on that?
Yeah, it's funny. So we saw that on the uprise of Donald Trump, actually.
That is funny.
Yeah,
But no, go ahead.
I was about to say.
Go ahead, man. Sorry.
Oh my God, bro! I was about to say, damn. Bro. Fuck, bro. But yeah, so we saw that on the on the rise of Donald Trump, and just going to the end, he starts screaming nationalism. And a few months after he starts screaming,
Talk about what nationalism and populism is, just so that people
so
can
did
kind
he
of
name
understand.
three? Did he? So
Wealth gap,
yeah.
populism, nationalism,
Oh yeah.
tariffs.
So obviously we know what a wealth gap is. Tariffs is tax on foreign nations usually by us. And so populism is like, it's more like you get like uprisings. It's more people focused, right? So you get like, let's say if I was a populist candidate, like if I
Hitler.
tried to appeal to the populace, he started off as populist and then became a fucking dictator. But yes, effectively it's for the people. Nationalist is for my borders, it's for my country. And so on that uprise of DT, good old DT, he started screaming nationalism. A few months after he started screaming nationalism, he started to impose tariffs on China during that trade war. And I think during that time, he also sanctioned Iran as well from using SWIFT and other payment systems. And so that's literally the perfect example of the progression of how that, you know, leads to nationalist policies here. Sorry.
You're good. It's not that bad. Okay.
But yeah, so that's basically the progression there.
Okay. Yeah, and it's just like the wealth gap populism thing. Like a wealth gap is like when the rich are getting richer and the poor are getting poorer, basically. And then you have someone stand up like, this shit shouldn't be happening. Like, I'm advocating for the people. Like, it's literally like a chain. It happens pretty much every time. So yeah. Next point, we kind of talked about this on the last book review. When capital chases unproductive returns, asset bubbles form. When they sell off, declines can be repaid. So it's basically just like an unproductive return is like, you know, you borrowing money and maybe buying art. And yeah, you can justify who you're buying the art from is benefiting, but it's one person benefiting versus multiple people benefiting, if that makes sense.
Yeah, and you kind of like, oh, my bad, go ahead.
When you borrow money and you buy like luxury items or, you know, anything that's not giving someone a job or feeding like multiple families, you can think of it that way, forms asset bubbles in the thing that they're buying. So it's like, let's say, perfect example, people borrow money and they were buying back their own stock. People borrow money and they're buying Bitcoin and crypto and different assets, and it forms these bubbles that eventually pop, and then the whole cycle starts over again.
Yeah, so you can even generalize this point a bit more there and just say, so it makes a lot more sense, easier on the ears as well. So when you have capital created without a corresponding increase in productivity, it causes inflation, and that could be asset or consumer inflation or both. So that's just to generalize that point a bit more.
Okay. Let me see this next point. Okay, so he was basically talking about in the book how our brains are not wired to quantify exponential growth. Like our brain just isn't set up. So he says here, not only do we, and I'm going to prove this to you guys, not only do we vastly underestimate exponential growth, we also have a second limitation. We base our future expectations on what we've experienced in the past. So just to give you guys an example on exponential growth, that's the whole adage of like, what would you rather have? A penny doubled every day for 30 days or $1 million? A lot of people would say $1 million, but a penny doubled every day after 30 days is 5.3 million. But you can see like exponential growth is like the growth curve when it's small, but then it's just like straight up hockey stick. Like it just happens so fast. It's not gradual at all. It goes from 0 to 100 real quick. Maybe that's where Drake got it from. Drake understands. It's like, nah. So day one, you got 1 cent, then 2 cents, then 4 cents, and 8 cents, and 16 cents. So even on the 15th day, you only got $163. You're like, man, I'm so far from a mill. You think it would just be like double this in the next few days, but no. Then it gets to 327, 655. Day 23, you were at 41K. Double 41K, 83K, 167K, all the way till you get to 5.3 million.
Man, bro, I've never thought about how crazy that actually is. Like looking at this right now.
Yeah.
Like, damn, bro. I mean, bro, I would not have hope on like day 10. Like, bro, $5. I should have picked $1 million. That's crazy. It turns into 5.3 million, bro.
Let me ask you guys another question. And this will bring home how we cannot quantify exponential growth. If I ask you to go outside and take 30 steps from your front door, walk in either left, right, or forward, whatever way your porch is set up, you can quantify where you be in 30 steps. You close your eyes, you work 30 steps, you're like, oh, I'll probably be here. Now, where would you be and how far would you go if I asked you to take 30 exponential growth steps? If your stride is 1 meter, 30 linear steps will take you 30 meters from the starting point. We just talked about that. With a 1 meter stride, 30 exponential steps will take you around the world 26 times. That's crazy.
That is crazy. I can easily picture that, walking around the world 26 times. I can picture that. It's like, no. Man, that's insane though, bro. Damn.
Yeah, so it's like when it comes to like helping you become a better investor, you want to invest in things that have, like, we live in this like nowadays your asset, it's not all about like the industry. When you buy something and you, like, if you're building a trucking company, you know, that's not really an exponential growth kind of business. Like, you buy a truck, you're like, okay, I can move this many loads, I make this much money, I can spend. But when you're building a company like Facebook, your value is in your network instead of your actual things that you buy, just like the telephone.
So yeah, you're basically referring to, like,
here we go,
with like a company like Facebook, companies who operate, you know, where the value is in their network. That's like Metcalfe's law. So the financial value or influence of a telecommunications network is proportional to the square of the number of connected users of the system. And that's literally the depiction of that right there.
Yeah. So basically it's like, that's a good point. So it's basically like when it's just two people using a network, only those two people can talk to each other. But even though it's 1, 2, 3, 4, 5 people here, you see it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 possible connections. And the more people you add onto it, the better. And that's when things start to become like exponential. And that's why Facebook is an exponential growth company. So is Uber, so is Airbnb, because the more people that use the network, the more valuable it exponentially becomes. So when you're investing, it would be good to look into companies that have the potential for exponential growth. And even though you can't quantify exponential growth in your brain, you can still model it by looking at how this company can potentially grow its networking effects. Next point here. The stock market collapsed in 1929, the dot-coms in the 2000s, the housing collapse of 2008 were all easily identified debt bubbles fueled by easy money policies of the Federal Reserve. Any crash that has ever happened, even if you go, like they were talking about 1929, that was financed by, that crash happened because like people were able to like finance cars and refrigerators and washers and dryers and all these kind of things were like kind of going mainstream. So you had all these people who weren't qualified to pay back their loans, financing cars, financing like utilities and stuff like that. But then when it became known that they weren't be able to pay for it, the people who was holding the debt start selling it, and everything just kind of like just cascaded, and it created a depression for that reason, and also because the Federal Reserve was kind of new. It was like its first big economic collapse that it had to deal with, so they kind of had to like learn from that. But basically, any bubble that you ever see, it can be traced back to somewhere in the economy, whether if it's through mortgages or corporations or financing cars or financing something. Basically, the means to finance that thing or product or service, the criteria was low as fuck for who could do it.
Yeah, I don't have anything to add.
The wave of socialism that overwhelmed the world in the 30s was barely years before. Policies that seem extreme in the boom times have a way of turning into necessary solutions in times of crisis. Two things here. So he said the wave of socialism overwhelmed the world in the 30s, but it was barely evident in the U.S. 3 years before. Socialism wasn't a thing in the U.S. back then because of gold. So people came to the United States to mine gold, and that's the biggest reason why we have this property system of homes. But when it's the strongest, through people coming over here to mine gold, people start building fences and saying, "Hey, this is my land, this is your land." They started creating like paper certificate, and over like a century, the government was accumulating all of that data, and it created what we know as the property system. And you know, if you have a means to show what you own, you can't borrow against that. And if you can't borrow against it, you can't create credit. And without credit, you have a third world country. A lot of that have that issue, they come from a socialism background because the government owns everything. So when you go from socialism to whatever else is next, it's hard to create a property system because the humans didn't own shit before that. So the next point is policies that seem extreme in boom times have a way of turning into necessary solutions in times of crisis. So like if you look at the Great Depression, 3 things out of that. FDIC, which is the Federal Deposit Insurance Corporation. I mean, I guess that's not like a necessary solution in times of crisis. Like you want to have insurance no matter what, but Exchange Commission, the SEC, came out of the Great Depression, as well as 401ks, because people weren't investing into the stock markets. And the SEC is the biggest point. So in a bull market, you don't want to be restricted from buying shit. Everything's going up. You're like, oh, it's fine. You know, I'm at risk. I get it. Yeah. But once you start getting scammed, like in crypto right now, a lot of people are calling for regulation because you have these hacks and people are getting scammed and all this stuff, right? They're saying like institutions are waiting on the sidelines, literally, because they don't want to get scammed. So like a perfect example of that. Like in bull market, no one gives a fuck about some regulating body determining what's the security, holding security issuers accountable. But after people get scammed, then people start calling for it. So that's like a perfect example. Did you want to?
Yeah, just super quickly. Yeah, when things are good, nobody's complaining, bro. If you're making money too, why would you complain, right? Because everything's going up. But yeah, once things start to turn around, of course, it just makes sense that everyone's going to complain. So, and a good example of the socialist comment would just be China. If people go look at China, trying to turn a socialist country to, or a communist country, whatever you call it, to a more capitalist style economy, is very tough, and it's showing in the way their economy is doing right now. But yeah, guys, I do have to run like right now, so make sure you subscribe and help us go exponential.
Come on now, that's how you end it. Real quick before you go, subscribe to
you always end it, bro. But that's I'm just throwing it in there. We're gonna be exponential. But yes, I do gotta run, so go ahead and wrap us up, my boy.
Yeah, subscribe to Know It Alls. You know, if you want to help the channel, let us know what you want to cover. Let us know what opinions you want us to cover, but also subscribe to our individual channels. My individual YouTube channel is Crypto Noah. JT's is J Mansion. I cover like all things crypto, DeFi. He covers all things economics, housing, real estate. And on this channel, we cover all things economics, crypto, book analysis that you see, as well as other esoteric topics like psychology and mindset that you need to have to be not just a good person, but most importantly, a great investor. Peace and love.